Namaskar and welcome to this deep dive by Value Pick Studies. Today, we dissect a sector sitting at the epicenter of India's financialization, the discount broking industry. The narrative on the street is split. On one side, we have the India shining story, fueled by a retail tsunami moving from bank FDs to the bazaar. On the other, the specter of regulatory tightening and cyclical fatigue. Are we looking at a structural compounder? Or is this peak cycle earnings? We are analyzing the proxy for this boom, specifically looking at the market leader in volume, Angel One. Let's strip away the sentiment and look at the hard numbers.
Let's look at the macro picture. The equity cult is no longer restricted to South Mumbai. It has traveled to Tier 2 and Tier 3 cities, from Indore to Aerode. We are witnessing a staggering addition of roughly 30 to 40 lakh DMAT accounts per month. This isn't just a blip, it is a structural shift in household savings. The SIP book alone has crossed the 20,000 crore rupee mark. However, as an analyst, one must ask, is this volume quality or just froth? The churn rate in active clients is the devil in the details here.
Focusing on the P&L, the beauty of the platform business is operating leverage. Once the tech stack is built, every additional order drops straight to the bottom line. Looking at the top-line CAGR over the last 3 years, we are seeing numbers upwards of 40%. But here is the catch. A massive chunk of this revenue, often over 60–70%, is driven by F&O, or futures and options. This is high-octane fuel, but it's highly volatile. If the retail trader blows up their capital, the transaction revenue dries up. It's a cash cow, but is it sustainable?
Now, we must address the elephant in the room. SEBI, the regulator, is visibly uncomfortable with the gamification of trading. We have seen the circulars. They want to curb the frenzy. Increased margin requirements or limitations on weekly expiries could act as a significant dampener on ADTO, average daily turnover. When the regulator tightens the screws, valuation multiples compress. The market hates uncertainty, and right now the regulatory risk premium is priced in. This is why you see the stock trading at a deviation from its historical mean.
Let's talk valuations. We are looking at a forward PE ranging between 15x to 18x for the sector leaders. For a company growing earnings at 30%, a PEG ratio under 1 usually screams buy. However, the street is discounting the earnings quality because of the cyclical nature of broking. Unlike an FMCG company where you buy toothpaste regardless of the GDP, you only trade when the market is bullish. If we enter a prolonged bear phase, that denominator in the PE ratio shrinks, and suddenly, the stock isn't cheap anymore. Pivoting to the technicals, the stock has been consolidating in a tight range, hovering around its 200-day moving average. This is a critical make-or-break level. We are seeing a formation of a symmetrical triangle on the weekly charts. A breakout above the resistance with strong volume delivery would confirm the resumption of the uptrend. However, watch the RSI. If it diverges while price makes a new high, that's a classic trap. For the momentum traders, wait for a close above the swing high before deploying fresh capital.
The bull case isn't just about broking, it's about the pivot to a super app financial ecosystem. By cross-selling mutual funds, insurance, and lending products to their massive 2 crore client base, they can reduce cyclicality. If they successfully monetize just 10% of their active user base with credit products, the ARPU, average revenue per user, re-rates significantly. We are banking on the platformization of the business. This transforms them from a simple broker to a fintech powerhouse. Conversely, the bear case is grim. If we hit a market correction of 20%, retail participation typically evaporates. History tells us that in 2008 and 2013, retail volumes dropped by over 50%. Add to that the predatory pricing from competitors offering zero brokerage. It's a race to the bottom on fees. If the race to zero hits the F&O segment, margins will collapse. The bear case assumes a 30% cut in EPS estimates for FY25 if these headwinds converge. Despite the risks, the balance sheet is pristine. We are looking at a debt-free entity with robust free cash flow generation. They are sitting on significant cash reserves, which allows them to invest in technology and acquire customers aggressively when competitors are struggling.
The return on equity, ROE, is north of 40%, which is stellar by any global standard. This financial fortress provides a margin of safety even if the cycle turns against them. To wrap this up, the Indian trading boom is structural, but the players are cyclical. We maintain a cautious accumulate stance. The valuation offers a buffer, but the regulatory sword creates a ceiling on the stock price near term. For the long-term investor, use the dips. For the trader, respect the stop losses. This is a high beta play on the India growth story. Keep your eyes on the monthly ADTO data. That is your pulse check. Until next time, invest wise and stay hedged.